Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories in corporate filings. Today we're diving into MFA Financial's latest report, and let's just say it looks like they're busy restocking the shelves, but with a very specific kind of merchandise. Stick around to see what that means for investors. And before we jump in, if you like getting these clear, no fluff breakdowns of major company news, make sure you're subscribed. Also, join our Discord community for more discussions. The link is in the description. Alright, so what we have here is an 8K filing from MFA Financial. Think of an 8K as a special bulletin. It's for reporting really important events that happen between their regular quarterly or annual check-ins. The big date here is August 13th, 2025, which is the earliest event reported. This filing tells us about some pretty significant moves MFA Financial has been making, mainly to do with how they're raising money. First up, they've entered into a new distribution agreement for what they call an at-the-market program for their common stock. Basically, they've signed up with a bunch of big financial players like Goldman Sachs, Barclays, and Morgan Stanley to sell up to $300 million of their common stock. This is a common way for companies to raise capital gradually. Instead of selling all the shares at once, which can flood the market and lower the price, they work with these agents to sell shares over time. Whenever the market conditions are good, the agents get a commission, in this case 1.0% of the sales price. This new deal also means they'd ended an older agreement they had. Think of it like a company using a real estate agent to sell houses. They list them and the agent finds buyers over time. The key here is at the market, meaning they'll be selling at the current ongoing stock price. But that's not all. They're also doing something similar for their preferred stock. They've got a new agreement for selling their Series B and Series C preferred stock, aiming to raise up to $100 million. This time they're working with Jones Trading and BitDig. Preferred stock is a bit different from common stock. It usually pays a fixed dividend, and it doesn't usually give you voting rights, but it has a higher claim on assets if the company goes bankrupt. Selling up to $100 million of this is another way they're beefing up their funds. The commission for this is a bit higher, up to 2.0%. This section is directly related to the first item. As we mentioned, they terminated an older distribution agreement. This is just a formal way of saying they closed out their previous arrangement for selling stock, likely to make way for these new, broader agreements. It's important they officially mark the end of the old deal. It signals a shift in their strategy or their relationships with financial partners. Now, this is where we see a real change in the company's structure. On August 13th, MFA Financial filed some documents that effectively increase the number of preferred shares they are authorized to issue. They're taking shares that were just sitting there as authorized but unissued common stock and officially designating them as Series B and Series C preferred stock. For Series B, they're adding 4 million shares, bringing the total authorized to over 12 million. For Series C, they're also adding 4 million, bringing that total to over 16 million. This is crucial. It means they've cleared the path to issue a lot more preferred stock if they need to in the future. It gives them flexibility to raise funds by selling more of these income-paying securities if market conditions are favorable. This section essentially rubber stamps the changes we just talked about in item 3.0. When a company changes its fundamental corporate documents, like its articles of incorporation, it needs to be reported. This confirms that the company has legally made these changes to its structure, increasing the potential number of preferred shares it can issue. And finally, the exhibit section just lists all the supporting documents. This includes the actual distribution agreements, the legal opinions about the share issuances, and the newly filed articles that allow for more preferred stock. Here we see the full list of underwriters for the common stock offering. It's a pretty comprehensive group of big names in finance. And these are the legal opinions from their lawyers saying everything is above board regarding the issuance and sale of these stocks. It's standard practice to include these. So what's the story here? MFA Financial is actively working to raise capital. They're using established methods like at-the-market offerings to sell both common and preferred stock. The increase in authorized preferred shares suggests they're positioning themselves to potentially issue more of these securities down the line, perhaps to fund operations, expand their portfolio, or manage their debt. Looking at this through a broader lens, MFA Financial operates in the real estate investment trust sector, specifically focusing on residential mortgage loans. Their business is sensitive to interest rate changes and the overall health of the housing market. Raising capital, especially through preferred stock, can be a way to strengthen their balance sheet, provide liquidity, or fund new investments. Now for the investor perspective, the common stock offering of up to $300 million signals a need for capital, which could be to buy more assets or repay debt. The preferred stock offering of up to $100 million also points to a similar need. Preferred stock is often seen as a less risky way for companies to raise funds than issuing more common stock because it doesn't dilute existing shareholders' ownership as much ever. It does come with a fixed cost in the form of dividends that must be paid. The fact that they're increasing their authorized preferred stock count is a strategic move. It gives them options. If interest rates fall, they might issue more preferred stock to replace higher cost debt. Conversely, if interest rates rise, they might be looking to shore up their capital base. What does this mean for you? Well, if you're an investor in MFA Financial, keep an eye on how they deploy this newly raised capital. Is it going towards acquiring attractive new mortgage assets, or is it merely to service existing debt? The effectiveness of these capital raises will depend entirely on the underlying investments they make. The commissions paid to the sales agents also eat into the proceeds, so remember that 1% or 2% commission is effectively money not going into the company's own pockets. In terms of risks, MFA Financial, like all REITs, is exposed to interest rate risk. If rates go up significantly, the value of their existing mortgage portfolio could fall and their cost of borrowing could increase. They also face credit risk, meaning borrowers could default on their loans. These capital raises are likely a response to managing these kinds of risks and positioning the company for future opportunities. Overall, MFA Financial appears to be proactively managing its capital structure. They're not sitting still. They're actively seeking funds to operate and grow. The key will be the efficiency and return on investment they achieve with this capital. It's a clear signal that they are in an active growth or management phase, utilizing standard financial tools to do so. Alright, that's our breakdown of MFA Financial's latest filing. What's your take on these capital raising efforts and what they signal for the company's future? Let us know in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description for more exclusive content and discussions. Thanks for watching. See you next time.